Welcome back, insiders. We have a big video tonight, and we're going to look at a major shift that is brewing in the stock markets and the economy. Of course, you know that I'm very reserved with my words. I will not say something that I don't take extremely seriously. So this is a video that I've been looking forward to. Started working on it last evening as we put out the insider's notice. We're going to start by recapping our public trade that was on Twitter. We'll just talk a little bit about strategy, some of the insider strategies that were applied. And then we're going to look at some of the insider trades a little bit later on in the video. That's going to be private portion. We have some winning retail trades, some other winning trades. We've had some big intraday options trading on SPY that have been very successful. We're going to recap a lot of those items. We're going to start with Amazon, but then we're going to get into the very important portion that we see with the economy, and there's a lot to cover. So let's get started. Today's trade idea on Amazon, I mean, these are pretty easy to break down because it doesn't get more simple than this. You know, it's almost perfect, right? Had the entry point of 120.05. And the best thing you can ask for, the best thing you can look for if you're predicting, if you're sharing a trade idea, if you have an entry point where you're going to see a bounce or a rejection, is that you literally hit it on the dot and it rejects and it almost looks like a V. So that's about as good as it gets for taking calls at 120.05. So that's pretty simple, easy entry here. And then it's just a matter of strategic scaling, right? Because having a good trade idea is just half of the battle. Probably a little bit more than half. The other portion, of course, is how you exit. Do you take everything off when we hit here and you get that pullback? Or are you exiting strategically? Of course, insiders, we know that we strategically scale out. I have videos on this. I have public videos for anybody who's trying to learn how to scale and what the concept is. The short story is that you don't take everything off in one shot. Depending on your size, you can take a little bit off. You can hold a little bit for a little bit more of a run, take more and more size off strategically as you go. In terms of entry, we take a look at the contracts themselves. Again, about as easy as it gets, right? This is a winner. You could enter it a little bit higher, a little bit lower. Of course, you see that we went under 120.05 just slightly. So benchmark at 63 cents, and it's almost a straight line up, right? We stag here. We kind of stall for a moment. There's a pullback here. The peak, I'd say you take a lot of your position size off at this point. So you're somewhere in the 90s. And of course, if you can hold to the peak, it goes to 112. This is just it's around 80%, but there's a smooth run here from 63 into the high 90s, right? Actually over a dollar. You get up to, what is it? Maybe 109. Yeah, 109. Then you get a pullback. You take off some size. So absolutely as close to perfect as it gets. You can't ask for more than that on the Amazon trade. Makes a perfect V right at our entry point. So we could park that. And let's move on. Let's take a look at the S&P 500, the SPY. So this is important. We're going to take a look at the SPY here. We could actually, you know what, we'll pull up the SPX first. And let's expand our timelines before we get into this. So what we're seeing, of course, we break to the top of a recent trading range that we've consolidated in. And a lot of this is centered around saying, okay, where are we with the debt ceiling? Do we have an agreement on the debt ceilings? What's happening with the Fed? So let's clear that out of the way first. Of course, we have a deal on the debt ceiling. Is that positive? Not entirely. Something we've been talking about within insiders for some time now is that immediately preceding the debt ceiling, the Treasury is going to have to raise money at breakneck pace. We're looking at upper estimations of $700 billion over the next couple months. We have estimations of $500 billion plus by the end of June. And that's quite a bit of money to raise. So how's that going to work? We're going to see a flood of T-bills into the market, a deluge of T-bills, and that's going to drain liquidity of the system for a variety of reasons. You're going to see people moving their money into T-bill funding, pulling it out of the markets. We have high rates right now. Now, the only thing that will modulate that, we'll have to see how the reverse repo program plays out, because that could help modulate the severity. But we are going to see a withdrawal, a rapid and a heavy withdrawal of liquidity. So that's one fallout from the debt ceiling deal. And that is going to happen rapidly as we close out through June. The only catalyst that could drive us for the moment that I see driving us is there's a lot of positive sentiment in the market. But of course, when things are moving up, sentiment starts to get better. And of course, there's a good likelihood that the Feds will pause. And we're going to talk a little bit more about that and pull up some statistics because we're going to get into some of the heavy portions right now. So we have potential right now to continue to hold ground, maybe even do well and rally a little bit more off of the Feds pausing should they do so, which I continue to believe is the more probable scenario. I've been open. I said I believe that the Feds they're going to cease their rate hiking in June as we start to see data come in and we've heard, well, the data doesn't look good. PCE is still high, inflation is still high. But remember, it's not as though the only way to modulate and combat inflation is just to keep raising rates. It doesn't work that way. Once you have sufficiently restrictive monetary policy, it's just a matter of time. And to those who are new and listening in, it's like saying it's going to cost you more if you're paying interest and I keep raising the rates. But it also costs you more if time just elapses. So the longer the Feds hold rates at this rate, that puts heavy pressure on the economy because you can only sustain for so long in terms of businesses and refinancing and paying interest. So you don't have to raise the rates to be aggressive. So when you see that there's inflation, when you see that there's elevated PCE, time will do that as well. That's why I always equate it to cooking something. If you're cooking something, you don't say, I have to keep turning up the temperature because it isn't cooked. That's how you burn things. You just leave it. You say, well, yeah, it's at 350 degrees. It takes a pie a little while to bake. You don't turn it up to 700 degrees and say, okay, I'll get it to bake in 2 minutes. No, you're going to light your house on fire. So let's take a look at some data and see where things are trending. And then we're going to get into the heavy catalyst that I've been talking about, that I've been discussing as a potential disaster for the economy. But we'll start here. Okay, so let's take a look. I'm going to pull this up. So U.S. employment wage growth probably slowed and moderated in May. This is sourced from the BLS, Bureau of Labor Statistics, and Bloomberg. What do we see? We see change in payrolls. This is a trend. We've seen this on the decline, right? We see change in hourly earnings hold flat. So that's an area that the Feds were concerned about. That's generally flat. We've seen some spike periods. We've seen some pullbacks holding flat. But what we see a change in payrolls is on a steady decline, right? So we're not seeing that expansion. And I've talked about this frequently. Every Thursday, you hear a number, and the big number to everyone that they circulate within mainstream media and the talking heads are constantly talking about new job losses, right? Unemployment, newly initiated unemployment claims, right? But that's not the only thing to watch. That's just what we're seeing. That's the rate. Remember, continuing unemployment is also very important. And after a while, you actually fall off the reports. So then we also look at labor force participation rates. So for those of you who don't understand that concept entirely, the change week over week is what's new, right? Continuing, well, did those people get new jobs? Because if they didn't, that's not good. That's extremely important. Continuing is even of more importance at that point. But at a certain point, you get removed if you haven't found work. So then we want to look at the overall unemployment rates. We want to look at labor force participation. How many people overall are working? It doesn't matter to me so much if there aren't many new people being added to the unemployment list each week. What I care about is the aggregate of the data. Well, if they're going back out into the workforce and getting jobs, okay, strong economy, strong labor market, great. If they're remaining on the outside, you can have a low number, but that low number is persisting and compounding. That's not good. That's not strength in a tight labor market. So we're seeing that subside a little bit. And now I want to get into something that I've talked about for some time. So what we've seen is we have an earnings recession, right? For those of you who don't know, 3.2% was a negative 3.2% was the earnings drawdown in the most recent quarter reported, right? So that is, of course, Q1 of 2023. We're projecting minus 7.2% decline in earnings for Q2. So that's multiple consecutive quarters that we're seeing earnings recede, earnings contract, earnings go down. Now, we see some negative markers in the economy. We see massive debt levels, and we're going to pull that up right here. So let's look at total debt. Total debt is rising sharply. If you trended this is an uptrend that is going to break. We're continuing to borrow, and it's heavy balances on the consumer, right? And we could see that credit cards, mortgages, credit cards are expanding, and we're also seeing there's student loans, of course, and we've seen credit cards break over 1 trillion. That was earlier this year. So the composition is broken down here, but we're seeing rising debt balances. Okay. So people are having a harder and harder time affording their payments. One thing that I circulated, and this was public on Twitter, was I circulated that we saw not only did debt accumulate and rise, we're seeing a rise in delinquencies, meaning more and more people are unable to pay their balances. And so this is one look at it, right? And we see that increase in credit cards not being paid, the seriously delinquent meaning 90 or more days, and this is sourced from Consumer Credit Panel and Equifax, We're seeing auto loans take a pickup. But let's look closer because I'm going to add something in here that is extremely significant. So what could add more pressure here, right? When we look back at that chart, what was flatlined? Student loans. Why? Because nobody's paying their student loans, right? Why is that? Because there's a moratorium suspending student loan repayment. Okay, so what do we have coming out of the debt ceiling? Out of the debt ceiling, we say 60 days from the date of signing, the day of passing the new debt ceiling, student loans will need to be repaid. Well, how significant is that? Well, as of 2021, and this is the expected amount, of course, because we have the moratorium, $393 per month, right? $393 per month. And how many people does that affect? Here's where it gets interesting. 40 to 45 million borrowers. That's 1 in 5, roughly 1 in 5 American adults. 40 million borrowers are going to be hit with $400 per month, approximately here, $393 per month. Now, what does that do? How does that trend on the charts? What is that going to do to the economy? How much damage does that inflict? Well, when you have people, when you look at a society-wide, we're racking up credit card bills. We see that breaking, it's broken 1 trillion. We see debt hitting an all-time high. People are having a difficult time servicing their debts because we've seen things break into delinquency. $400 per month being added to 40 to 45 million Americans. Now, let's take a look at that and see what it looks when we chart it out, right? So if you look and you look at the trend, because that's so important, we'll zoom in on these as well. What's the trend that we're seeing in delinquencies, right? This isn't in debt, because you hear that all the time with talking heads. There's debt, there's not debt. It's hard to tell if people can service that, if they're running out of savings. Well, keep in mind that through this period, right, the numbers looked good. And even now, people have excess savings. Why do they have excess savings? They have excess savings from COVID. Everybody was mailed checks. And then you see people being able to refinance at lower rates on their mortgages, people taking out credit cards. There's unemployment, people being paid more to stay at home than they were to go to work in some cases, et cetera, et cetera. The reduction of costs, right? Because if you went from working in the office to working at home on the same salary, that is a reduction of costs. Could be a few $100s a month, right? Why? Well, because you're not eating out, you're not driving, so you don't have the cost of transportation, the cost of gas, the cost of meals. You may be able to care for children who could be at home instead of paying for daycare and sending them off. So there's a lot of excess savings and money being put in the coffers. And what happened? Student loans plummeted, went to near zero, right? Well, of course, there's no delinquency. We don't have to pay your student loans. Okay. And, this is noted here as well. So student loan data, a little bit of data on the student loans from 2004, et cetera. We have notes on that because the data wasn't even reporting. But of course, you see that plummet. But what do we see? We see credit cards already rising sharply. From a trend perspective, what this tells you is that people are hitting their breaking point, right? When you start to see delinquencies rise like this, as you see credit card overall debt rise rapidly, which we have been month over month, and it all sounds like it's nothing until all of a sudden it implodes, right? Because what do you do with a credit card when you have one? Let's say that you're in a bad place. You put money on your credit card, you put debt on. You keep putting more debt on. So it looks fine and you can make your minimum payments. When does that change? Well, there's nothing progressive about it. It's binary, meaning you either pay or you can't pay, right? You either become seriously delinquent or you don't. You make the payment or you don't. So at what point do things break? When you just don't have any more space to borrow and you can't afford your payments. That's how it works. This recent trend, which is accelerating, shows an uptick. Remember, trajectory and pace is everything, right? Percentage, the amount of people, etc., is different, but its trajectory has risen sharply. People are falling into delinquency. It's 90 days plus. We're seeing the same thing on auto loans. Now, what's being preserved, the last thing, even though it's on an uptrend, and we're going to zoom in on that in a moment, is mortgages. Why? Because people tend to go and allow their credit cards to become delinquent first, right? Because it'll be collections, you'll have an argument with the credit card company, you'll end up paying, perhaps settling for a lesser amount. Then they prioritize protecting their vehicles. So that's their auto loans, even though those are on the sharp rise. Why? Because they'll show up and take your car away. You become seriously delinquent, your car will be repoed. So you'd rather fight with a credit card company and have them send you a bunch of letters than have someone show up at your office or while you're out for coffee, tow away your car or on your driveway, etc. And what do you protect the most? What do people tend to protect the most? Of course, the mortgages. They don't want to go delinquent on their homes. And what do we see here? Sharp uptick, beginning to rise, sharpening, starting to rise. Okay, so let's close that out. But let's look at the transition, right? So again, bear with me. I know it's a little bit more of economics, but this will absolutely impact the stock markets. So let's take a look at the transition into delinquency, right? And we'll have a good breakdown here. So let's pull this up right now. This is where it gets interesting because this is where it ties into student loans. This is looking at people who have transitioned from not being delinquent into being delinquent. Where do we see the biggest uptick? 18 to 29, student loan payers. Then 30 to 39, highest levels, second highest levels. Of course. Why? Because these are people who are oppressed and they're going to be paying their student loans. This is the most at risk, right? They're younger, they haven't amassed as much capital. We see sharp upticks everywhere. Not so much in the older generation, not so much in the 70s. Kind of an uptick. You actually see a move down here, 60 to 69. But the people who are impacted by having to pay their student loans, number one, 18 to 29, 30 to 39, 40 to 49. And we see sharp upticks in seriously delinquent auto loans, right? That's not good. Why is that not good? Because these people who are having a hard time paying their auto loans are about to get a new auto loan. $400 a month is approximately what you might pay for a new car payment. Of course, it depends on the car payment that you have, but you can lease a nice vehicle for $400 a month, or you could before the numbers went ballooning. You get the idea. So how about the transition to delinquency by age for credit cards? Even sharper, coincides with what we're saying. Look at that rocket for 18 to 29. Look at that sharp uptick for all age categories. Again, we see that softening in the older generation. Again, these people, the most afflicted here, blue and red. Look at their rates right now of delinquency through Q1. They're about to get tacked on $400 a month. And then we're going to take a look at just one more here. And a transition into serious delinquency by age period, right? And where do we see people hit the hardest? Where it really breaks here. Just overall when we aggregate auto and credit cards. And of course mortgages are in here as well. 18 to 29 getting hammered. And why do we see these numbers a little bit suppressed in the older age categories? One, they're not as leveraged to student loans, but there's another reason here, and I'm going to show you in just a moment, is that, pull this up, mortgages. Home ownership is far more prevalent in the 30 plus category, and those are the most protected. So what happens is when you look back, the older category, right, above 18 to 29, because of their home ownership and because they've been protecting their mortgages at all cost, of course, because you don't want to go delinquent on your mortgage, right? You prioritize that. That actually skews this overall statistic. This overall statistic is just serious delinquency when we combine the three, right? So the fact that they're taking care of their mortgages is very helpful. In fact, everybody's taking care of their mortgages, but it impacts 30 plus more because those are made up of more homeowners. There's far fewer homeowners between 18 to 29. Not saying there's no homeowners, but the majority of homeowners are in the older age bracket categories. So what do you see? That pulls their numbers down here. And this is what you see in the younger generation, right? Because their statistics are more leveraged to auto loans and credit cards. So what do we see going forward? That's heavy pain on the economy. These are the statistics. These are the trajectories that we see. Rocketing, this is a rocket. When you see this on a chart, put it this way, if this was your portfolio and you saw this, you would be jumping for joy, right? If this is your debt, this is not good. You see it taking off rapidly. And what we know from the initial chart is that's partly because student loans have been almost nothing. So now you introduce the burden of the average price of $400 per month being tacked on to everyone. All the while, we know that initial jobless claims have been trending up. Unemployment overall has been trending up. Earnings are coming down again. There was corporate earnings across the board in the stock market, down 3.2%, projected to be negative 7.2%. But just so everybody who's new here or maybe listening in for the first time, they'll probably beat that because that's the Wall Street game. As you project, we're gonna be down. It's gonna be down 7.2% for the second quarter, and then you come in at 5.8%, and they actually call that a beat. This is the trick. You're down 5.8%, but you're not as down as bad as you could be, so it's a victory. This is just a presentation trick. It's still an earnings recession, down in corporate earnings across the board. So we see this, of course, on employment. We see this on wage growth, and we see this heavy burden being added to students, and that starts the end of August. Now, what makes that worse is the timing. The timing couldn't be worse because it's heavy pressure across the board economically. We already see credit cards moving up. We already see auto loan delinquencies moving up. And remember, those aren't delinquencies saying you missed 1 month. Anybody could be late by 3 days. That could be a scheduling issue, though it shouldn't be. Be careful with your scheduling. It could be a variety of different items. It could be a one-time incident. Those are 90 days plus. When you haven't paid something for 90 days, you are seriously delinquent because it's not a clerical error. You know that you haven't paid it. You don't think that you might not have paid it. You don't just simply forget, oh, did I pay my car loan? You have letters and phone calls at this point, threatening letters and phone calls, and you still haven't made those payments. And yet, auto loans rising sharply. These are people who are risking having their vehicles repoed, right? Credit cards. People hitting their limits won't be able to use that as a pipeline for money, right? And if you're using your credit cards to this extent, what do you do when that $400 a month burden gets introduced at the end of August? This is highly detrimental to the economy. So how does this impact corporations and what does it do to the SPY and S&P 500? I'm just going to put this here for a moment. Well, of course, if the consumer gets crushed, everything gets crushed. Within insiders, we've had some really interesting trades on a variety of retail. You see Target, Walmart, the indexes for retail. We've gone short. We've gone short, and those have been big winners because it talked about heavy pressure on the consumer. Well, when you can't afford to pay your credit card, when you've run out of space, can't pay for your car, and are struggling, you can't make purchases as a consumer. If the consumer falls, the GDP crashes. If the GDP crashes and the consumer falls, corporations fall. Why? Because where do corporations get their money from? It doesn't matter what corporation you are. We could pull them all up. You could pull up your favorite company that we're bullish on forever, right? Apple. Apple's a strong company. Okay. Apple requires the consumer. Everything that Apple has. You're buying a MacBook, you're buying a new iPhone, you're paying for Apple services, you're buying apps off iTunes. You're probably not buying apps off iTunes if you can't afford the basics. Okay. Microsoft, consumer facing. Meta. A lot of people don't understand how Meta makes their money. Meta makes a lot of their money on advertising, right? Advertisers are concerned with conversions. So when you run an ad, the way that it works, for those who don't understand, right? And this is an area I was a CEO in, and I won awards for this, and I've posted, and you can look it up. It's a public record. This isn't not delivering my resume here as a tech CEO, but this is an area I'm intimately familiar with. So you buy ads and you run them on Meta or a social media platform or Google, etc., because this applies everywhere. And this helps you understand how much pain there is in store economically and what that does to our winning companies, because right now the markets are being led by tech. So Meta is an example. I go out and I say, I want to advertise my product on Meta. This is how they make money. You have this big social media network and there's a lot of eyeballs, right? That's what you've done. You built this really cool product to bring in eyeballs. Just like building up, creating a good TV show. You don't make money because the TV show is cool. You make money by proxy. The TV show is cool, so more people watch it, so you can charge more money to advertisers who want to run commercials in between segments. It's the same idea with Meta. I run ads on Meta, right? Now, I pay a rate. We call this a CPM typically, cost per mil. So for every 1,000 ads and impressions, I will pay X dollars. And sometimes you can do it by conversions, everything. It all comes down to performance. Meaning, as an advertiser, I'm willing to pay more if I can get an ROI. How do I get a return on my investment? Well, people see my ads, click on it, and they make a purchase, right? Now, individually, it can vary quite a bit. You can have a great ad campaign and it can make a lot of money and you could do well, and you could have a poor one. But in aggregate, we look at the averages. And what happens to the average when the consumer is under stress? People stop buying things. It doesn't matter if you have a great campaign. The great ones will still do better and the bad ones will still do worse. But all ships drop with the falling tide, right? Everybody ends up in trouble. We don't make purchases for ads. So then what happens with Meta is they have to lower the amount that they're charging, because what happens is people say, I'm not going to bid on your ads because if I pay $10 per 1,000 impressions, I'm not making money anymore. So I either have to lower my bid or I have to stop running ads. So then Meta charges less money, Meta makes less money. There's less money for everybody because advertisers can't afford to pay the same rate or run the same volume because consumers aren't buying things. Who are the consumers? Well, everyone across the board. And when we look at student loan repayments, that's 40 million people. Now add that to the rise in unemployment, which isn't simply for students, right? That's across the board. When we pull up this statistic, that's not simply students. This is across the board change in payrolls. When we talk about falling corporate profits, and you can look this up, corporate profits were down across the stock markets, minus 3.2%. That does two things. Not only does that put stress on companies, which don't necessarily jump towards saying, okay, we need to cut staff. That's usually the last thing they like to do, which is why unemployment can be a lagging indicator, right? As the economy tightens and you see less earnings coming in, then you start to let people go. Think about it if you owned a company, right? You sell ice cream at your shop, and let's say you have one bad month. Okay, you go out and fire everybody? No, you say, well, I'm going to have to retrain everybody and rebuild everything. No, I keep them on board. And then you have another tough month, and then you start watching the numbers more closely. And if you continue to have bad months, you're going to have to make cuts. You're going to have to make decisions. Are you overstaffed? Do you have too many people? Do I need to have 5 people in the ice cream shop if the number of patrons in the ice cream shop have decreased substantially? No, I don't need that many people to service them, right? So this is across the board. But in that one category, which affects 40 to 45 million people, we have a sudden payment liability debt of up to $400 average. Now, a little bit of that's going to be modulated because they are setting caps based on your salary, but it creates a burden for people that we see, again, across the board, struggling to pay their auto loans, across the board, struggling to pay credit cards, and that's 90 days plus. So when we talk about any of the corporations, earnings get hit hard, and it counts for Meta, it counts for Google, it counts for Nvidia, that counts for Amazon. That counts across the board. Now, Nvidia's in a little bit of a unique situation. We've talked a lot about our strategy for investing and trading in AI, but setting that aside, we look across the board, and what else does that do? That puts a tremendous amount of strain on real estate. Because remember, there's still that 30 to 39 age category that's heavily impacted here, right? We weren't absent of everything. We weren't absent of that in the older age categories. We still see a huge uptick. That trajectory, 30 to 39 is big. That trajectory, 40 to 49 is big, right? We still see the trajectory, even up to 50 to 59, we still see a little bit of an uptick. And it's not such that only 18 to 29 are paying their student loans. 30 to 39 are paying their student loans, and so are 40 to 49. More impacted on the blue and red, right? So what occurs is come August, they get tacked on. Now, does that mean come August you have a one-time $400 payment, you make one payment for 1 month, that did you in, you're upside down, you have to sell your house, you're bankrupt, flee to a different country? No, that's nonsense. But that amount of pressure will start to stimulate the real estate market as more people will be required to liquidate, which is why what I've said frequently, I've talked about this, and you'll note that I mentioned the ticking time bomb of student debt over a year ago to insiders. I said that will come due when that moratorium ends. And if it ends sooner, it gets worse because the timing is horrible. There's so much pressure on the economy. This number will now start to tick up. Why? There's only so much you can do in terms of credit cards. You hit your limits. Only so much you could do in auto, right? Now, mortgages will be the most shielded because the last thing that you want to do is not pay your mortgages. In fact, before going delinquent, what we see is a lot of people just sell. And the real estate markets have been dry. I think that is set to increase as a result of necessity. And it'll be interesting, particularly if the Feds pause and later in this year pivot, because their pivot should coincide when we're in the deepest portion of the recession. Now, discussing the recession, showing that all indicators are leading indicators, everything points to consumers are already under a tremendous amount of stress and pressure. It is becoming unbearable. So why don't we wake up tomorrow and see the markets crash? Because it's not unbearable yet. Again, the ice cream example, right? How come everybody's not just being fired? Companies need to see their earnings slide more. So it's self-perpetuating. Companies are seeing their earnings slide because consumers are weak. Why are we? Remember, you have to ask yourself. We came in lower with earnings this quarter. Why? What happened? A lot of people don't ask why. The only reason we came in lower across the board is because there's economic weakness. We're projecting an even weaker quarter two to be in the earnings recession, 7.2%. Why? Because we're seeing even more weakness. And where do we see that foreshadowing? We see that across the board with retail. We see Walmart down. We see a lot of the cyclicals. We see a lot of companies behaving exactly as they did before the last financial downturn, before the last recession. So we see a major shift occurring. The Those payments start in August, and we're going to have a tremendous amount of opportunities. I've always said it could take a little bit of time. The inexperienced investor looks at this and says, well, I heard there was going to be a recession and it didn't happen the day after, so it's not going to happen. That's almost like seeing a hurricane off the coast on the radar, then walking outside and saying, seems fine to me. There's no such thing as a hurricane. Well, that's not the way it works. It depends where it lands, right? The probability of the market suffering on a recession, extremely high. Now, is there any chance this doesn't happen and we just keep careening upwards based on sentiment alone? I don't like to say anything's 100%. Everybody knows that I'm a little bit of don't have a lot of personality, and I'm a little bit of a robot when it comes to everything. So absolutely not. Probability is such that even 0.1% you have to attribute a possibility to something. But it would be the first time that we've had a serious recession where the markets did not react, right? And putting aside anomalous events, I'm not talking about COVID. We still had a huge retraction. So if we would go back to COVID, the markets crashed before quantitative easing began. So the likelihood of a recession, very high. And the probability of the markets pulling back during recessions happened every single time. So the question then becomes, what is the likelihood of a recession? Extremely high. Okay. So in order to untether what happens to the S&P 500, the SPY, SPX, to untether that from a potential recession, right? To say, okay, I think we'll go into recession, but the markets won't react. In order for those to be untethered, it would have to be the first time that's happened. Can there be a first time? Is there a first time for everything? There can be, but are there reasons why it happened? Is it just like a coincidence? It's not as though, on the day when I ate a lot of pizza, it also rained, and it's always happened my entire life. And then it deviates and it's like, oh, well, correlation wasn't causality. Well, in this case, correlation is causality. The markets go down because earnings rupture and they tank. And if we don't already have a catalyst, which we do, because the longer we stay under heavy rates, the more it's driving markets down. Yes, we're seeing a rally, but earnings are actually worse off. And when earnings are worse off, but prices go up, what does that mean? It means you're paying a higher and higher and higher multiple till it gets ridiculous, right? Now, might one or two stocks withstand and do well? Yeah, there are some resilient securities out there. We target some. There are some that do better as the economy takes a downturn. But what do we see overall? This is the catalyst we've been looking at, and the timing couldn't have been worse for student loan repayment to be accelerated, right? If there was a way to avoid it, the time to reinitiate that, I would say would have been a year from now, we'd be in the clear. But to tack that on during a recessionary downturn, when all other indicators are going negative, when credit card bills are piling up, when auto loan bills are going in default, high delinquency rates, that is something that breaks people. And to those who think that $400 a month isn't breaking, $400 a month applied to 40 to 45 million Americans when people are already stressed, that is breaking. Again, that is the cost of an auto loan, right? That is a portion of your mortgage. For a lot of people, I think the average mortgage is $2,300 or $2,200 per month. Okay. Imagine your mortgage payment increasing by about 18%. That will break people. So stop there for the public version of this video. That's just an oversight and some insight I'm happy to share. I love educating and helping retail get a better view of the markets. And for insiders, stay tuned.